so much for having me in and on to speak to you guys today. Tal says I can go for about 3 hours. I hope that's okay. Just kidding, Tal. You're right. It's only got about an hour that I'm going to spend with you guys, and we have a lot to cover. And like when I was introduced, I do a lot of writing for a lot of different places. So every week I write for The Guardian, for The Hill, for the Philly Inquirer, for the Washington Times, for Forbes, for Entrepreneur. But I also do something else. I mean, my day job is, if you haven't figured out by the looks of this already, I'm a CPA. Big surprise, right? I have a practice outside of Philadelphia. We have about 600 clients. I speak to thousands of business owners every year, and that's what we're going to talk about today. I want to talk about some specific issues that are facing this industry, and I want to talk to you about some strategies and tactics for dealing with those issues. I have for years that I've been doing this, and it's been like 15 years. I mean, guys, I have to tell you, I've been obsessed with I've been obsessed with business owners around the country that navigate their way through challenges like we're seeing right now. This isn't the first time they're having inflation, obviously. There's been inflation since the times of Cleopatra. This isn't the first time that there's been tight labor markets. There's always been tight labor markets. So, things that we need to do to control our cash, cut overhead, manage our businesses, nothing is new. It is amazing to me, though, that there are some businesses, and you know who they are, that have come and they have gone. They have survived good times and bad times. They have gone through multiple generations. They have gone through good political administrations and weak political administrations as well. They've weathered a lot of different ups and downs, and they're still here. These are businesses that you and I both know. We see them in our hometowns that have been around for decades, generations. Maybe your business is one of those businesses. And I've always been obsessed with those businesses. I've always been obsessed with what makes those businesses tick. Why do they succeed? Why are they sustainable? Why do they stick around for so long? And I've thought about this for a long time. And I've interviewed thousands of leaders, managers, executives, business owners all around the country over the past 20 years that I've been doing this. And I have to tell you something, I have learned what the secret sauce is. If you are ever wondering, what does it take to run a successful business for a long period of time, to really provide a sustainable livelihood, I found out what that is. Now, of course, the most successful business people that I meet, they work hard. I get that. They get up early, they're innovative, they're good with people. That all comes without saying. But there is one thing that people run businesses for a long time all have in common. There is one big thing, and it's this. Those business owners are always looking ahead. As I am talking to you right now, it is the middle of October 2022. The smartest clients that I have, the smartest readers that I have, the smartest leaders that I talk to, they're not thinking about 2022 anymore. In fact, they're keeping their eye on the ball. They don't want anything to go off the rails. But really, their minds are on 2023 and 2024 and 2025. They are thinking 2, 3, 4 years ahead. And that's what you should be doing. And why? Because you and me, I have 10 employees in my company. We have people that rely on us. I have clients and suppliers and partners and employees, just like you, that are relying on me not to screw things up. They have their families and their livelihoods that are hoping that my business and your business will still be around 3, 4, 5 years from now. So they've got jobs, they've got opportunities, and they can have their lives as well. It's a lot of responsibility that we have, but that is why we make the big bucks. That is why we are managers and leaders of the companies that we are. So we have to deal with certain issues, and there are lots of issues to deal with this year, and that's what I'm going to talk about. But here's the thing. When I talk about some of these issues, which I'm about to jump into, and trust me when I tell you, you know what these issues are. Inflation and supply chain and recession and labor issues, all of that. Even when I dig into some of these issues, just know this, okay? As much as you know what these issues are, I'm going to share with you what my smartest clients, my smartest leaders, my smartest readers, what they are doing to navigate their way around these issues. You don't care so much that inflation is high. You know inflation is high. You care about what do you do to navigate your business around that. And I'm going to tell you that in the next few minutes because I've got information to share. I am your reporter, your vessel, to share with you what other smart business leaders in America are doing in 2023 to navigate their way around it. Now, of course, the first big question that we have is, and the title of this presentation is whether or not we are in a recession. Are we in a recession right now? Well, if you look at gross domestic product, it fell for 2 quarters in a row, and we've got another GDP reading that is coming out, I think, in the next week or two. Call me crazy, but ever since I was an economics major in college, the standard definition of a recession is 2 quarters of negative GDP growth, and that is what we have seen. But I don't know, it's 2022 now, and so people are starting to different words mean different things. But that could be one indicator that, yeah, we may be in a recession. Other industries not doing so great. If you are in the construction industry, you are definitely in a recession right now. This is the Home Builder Confidence Index. It has plunged after hitting historical highs during COVID. It is now down approaching historical lows. This is from the National Association of Home Builders. And by the way, all this data is up to like yesterday. So this is what's going on, right? If you're in the mortgage industry related to the real estate industry, mortgage rates have doubled in just the past year. It used to be 3% this time last year. It is now over 7% in some places around the country. Not a great time to get a mortgage, and the rates continue and will continue to go up. Not good for the real estate and construction industry. As a result, existing home sales are off by 30% since January. And housing inventory, which you can see a year ago was at these levels, now they are at these levels. They're off 35% since the beginning of the year. Yeah, if you are in the real estate and construction industry, you're in a recession. You are definitely in more than a slowdown. And because of that, we are now seeing indirect effects promulgate their way through the economy as the layoffs begin. Just today, Microsoft announced the layoffs. Just last week, Salesforce announced layoffs. Big banks and investment firms have always announced layoffs. In the tech industry alone, tens of thousands of people have been laid off since the beginning of the year. I mentioned real estate and construction, all hitting some of the bigger companies around the mortgage industry, the real estate industry, the sales of real estate industry. All the bigger companies are laying people off. And it's predicted, this is just as last week, that 50% of companies are expecting layoffs in the next few months. So all of those things that have been going on in the job market, and the employees making their demands, and all it's coming home to roost, because as the economy gets slower, more of those employees are going to find themselves out of jobs, and that might open up opportunities for us to hire some of those people. So there is a bright spot to that, but layoffs are happening and more layoffs are coming. Where are the layoffs happening and where are the issues most? Well, manufacturers. Manufacturing output right now is the lowest that it has been since July of 2020, according to the S&P Global Manufacturing PMI. If you look at consumer sentiment was here back in 2018. It is now here in 2022. It is at a 5-year low, according to the University of Michigan's monthly polling of consumers. Logistics inventory. FedEx itself has said that their freight volume has dropped 11% just this past quarter. They're seeing a deteriorating number of shipments happening right now within the shipping industry. And if you look at port activity, remember when just a year or so ago, there was this big backlog of ships off the California ports, and it was having an impact on supply chain, and oh my God, were people going to be able to get their Christmas gifts in time, whatever? Now it's the opposite. Now, cargo shippers, this is as of last week, are canceling sailings as global trading has flipped now. And when things are being shipped, they're in empty containers. The number of backlogs, this blue number that you're looking at here, is what is showing where we are. It is up much more higher than it has been in many, many, many months. So port activity is declining. Small business sentiment. The National Federation of Independent Businesses polls its small business owners. There are tens of thousands of them. 30 million small businesses in this country, providing half of the country's GDP and half of the country's labor force as well. Small business sentiment as of this past month is the lowest it's been since 2013, almost 10-year low that it is at right now. When small businesses are not feeling confident in things, they're not spending money, they're not hiring, they are cutting back. That has a big impact on the economy as well. As an effect, markets are down. Since the beginning of the year, the S&P index is now down. S&P 500 index is now down almost 25% from the levels it recorded back at the beginning of the year. And interest rates are up. Interest rates used to be 0.25% at the beginning of this year. Now they are up at 3.25%. That is the federal funds rate. You should be so lucky to get an interest rate at 3.25%. This is the rate that the Federal Reserve is charging its banks. That's the cost of their money. They're turning around to make a profit and charging you a lot more than that. Typical business loan rates now are anywhere from 6 to 9%, significantly higher than the business loan rates that we saw just a year ago. And by the way, with the recent inflation numbers just announced, and I'm getting to inflation in a minute, the Federal Reserve is on track to increase these interest rates another 75 basis points within the next month or so, which would bring up their federal funds rate to 4% and drive commercial rates probably to double digits at that time. All of that stuff is going on, all reason to feel, well, a little bit nervous, okay? I get that, all right? I mean, you know, when things are not going so great, okay? However, I do have some good news for you. Let's talk about some bright spots in the economy, okay? For starters, there's travel. The Transportation Safety Administration, the TSA, they are reporting travelers levels right now at 2019 levels pre-pandemic. So the travel and leisure industry has recovered and doing pretty good. And if you've been on a plane anytime recently, I'm sure you'll have been seeing these effects. Household net worth, although falling because of declining real estate values and the stock markets, are still, when you look at these levels, at all-time highs. So people are not feeling super poor that have savings and investments, although they've seen them go down, but they're still higher than they have certainly been in their lifetimes. Retail sales continues to recover. These are retail sales levels as of the most recent month. Look at how they continue to grow even compared to the months before and the year before. In fact, Wall Street Journal just reported last week that retail brick and mortar stores are reporting its biggest revival in years. There are more stores opening up than closing because people are getting out and doing shopping instead of just clicking online, more so than ever before. That's also a bright spot. Speaking of online, e-commerce sales, they're up 7% through the middle of the summer. Meanwhile, unemployment remains at record lows, like a 40 to 50-year low our unemployment rates are, although I do see those layoffs starting to begin. But boy, to get to unemployment rates that we saw, well, clearly not during COVID, because that was really extraordinary, but even during the last recession, we have a ways to go before we get back up to recession-level unemployment rates. Right now, at the rate that we're at right now, it is so low that it will take a long time to get back to that level. On the services side, this is the Institute of Supply Managers Service Index. Anything over 50 is growth. Anything below 50 is contraction. We certainly contracted in 2020, but I mean, look at the growth levels that we've had. I mean, we had big, high growth levels back at the end of 2021 in services activities, but still pretty strong. Services, these are business services and consumer services. Architects, doctors, healthcare, landscapers, computer consultants, technology firms, they're all still doing pretty strong and pretty good. And when you look at the banks, I mean, just this past week on October 14th, yes, banks announced a profit drop mainly because of less M&A activity. But listen to them, household spending is mostly holding up. If you look at two big bank executives, this is Charles Scharf of Wells Fargo. He said that both consumers and business customers remain in a strong financial condition. This is as of this past week. And not only that, if you look at Jamie Dimon, who is definitely a negative guy on the economy, even he has to admit at JP Morgan Chase that consumers remained healthy as plentiful job openings and still ample household savings for now has kept credit card spending up and bad loans down. These are, by the way, this is not a survey. This is like their data from their banks as of this past week. So that's a good sign. Listen, all of this stuff, it's enough to confuse a guy, don't you think? I mean, you know, is it bad economy? Is it a good economy? Are we going up? Are we going down? Are we in a recession? Are we in a recession? Well, the answer is it depends. And the reason why it depends is this. This is a map of the United States. And each state is shown by the comparative GDP of another country in this world. Guys, we live in a huge country. 350 million people, the world's largest economy by far. The entire state of California has a bigger economy than the United Kingdom. The state of Florida has a bigger economy than Mexico. Texas has a bigger economy than Canada. I don't even know the names of some of these states in the middle, and they have bigger economies than a lot of the countries all around the world. In this country itself, you can't just say, is America in a recession? Because the answer is no. It depends on where, and it depends on what industry you're in and where you're located. If you're in real estate, if you're in manufacturing, yeah, right now you're suffering some pretty significant slowdowns. The same with technology. If you're in retail and restaurants, travel and leisure, so far, so good. The same thing with services as well. So you gotta ask where. So what we've learned so far, parts of the economy are in a recession, but it's not another great recession. It is a slowdown depending on who you ask and where they are. Now, big thing driving the slowdown, of course, is inflation. Just this past week, inflation was reported to increase. Our inflation rate now is at 8.2%, still at like a 40-year high. But you know what? Don't even pay attention to those numbers. That's the consumer price index. That is a lagging indicator. That happened in the past. What you want to be paying attention to is the producer price index. And the producer price index, even worse. That rose at 8.5%, slightly down from August, but still at a very high level, more than what was expected. Producer prices is what it costs to make stuff now. This will convert into consumer prices, I don't know, 2, 3, 5 months from now when this stuff ultimately does get to the market. So if we're seeing 8.2% consumer price inflation right now, and our stuff to make stuff is 8.5, we've got a while to go before we start getting our inflation rate to start coming down. It's going to take a while. So we're going to see persistent inflation over the next year. By the way, when you see 8.5%, do you think, does that make sense to you? Is this something that you're like, oh yeah, I can definitely agree with, right? Probably not. And let me explain to you why. Because I think, in fact, I don't even think, I can prove to you that you're not going crazy, that you have seen prices in your industry much higher than 8.5%. Let me explain to you why. I mean, listen, we're in the walls and ceiling business, right? We're in the construction industry. The cost of gypsum building materials has increased 18% over this past year. And by the way, these are all PPI numbers that come from the Bureau of Labor Statistics and other sources. Remember that producer price index is made up of a composite of like 1,000 different items. So that's where you're getting down to that 8.5%. Let's just look at this industry. Building material, gypsum building materials up 18%. If we look at the cost of clay floor and wire, like producing like a clay floor and wire tile, that's only up 6%, not 8%, but 6%. So that's not so bad. However, the cost of clay building material and refractories manufacturing, that's up 11%, which is the cost of some of your core materials as well. The cost for precast concrete architectural wall panels, which again goes into some of the materials that you are selling, 20% increase year over year. Yeah, the cost has been evening out and even starting to decline, which is good news, supply chain related, but you're still looking at 20% higher cost than you were paying just a year ago. If you look at the cost of vinyl coated fabrics, including these expanded vinyl coated stuff, that again goes into the materials that you sell, that's not an 8.5% increase, it's a 10% increase over this past year. The cost of industrial chemicals, 10% increase over this past year. The cost of steel piping and stainless steel, a 30% increase over the past year, not 8.5%, 30% over the past year. And now let's talk about just transporting stuff. If you are ordering materials from overseas, the cost of overseas sea freight right now is at 30% higher levels than it was just a year ago. If you are getting something flown in by air, it's not an 8.5% increase, it's an 11% increase compared to a year ago. And if you are just going to ship stuff on the ground here in the U.S., you're looking at 17% increase in general freight costs. These are all the core costs that you are using to run your business right now, much higher than what the government is reporting at 8.5%. Do you agree? And also, let's look at labor. Labor costs are only up right now, average hourly earnings about 4.9%. That has actually dropped. Now, it's not the 8.5%, but it's still a 5% increase. This is a survey that was taken by the Bureau of Labor Statistics. I am warning you that the cost of compensation, total compensation, is at 6.2%. ADP, the largest payroll firm in the country, just reported that their customers are paying costs for their labor 7.8% increase over the prior year. All of these numbers, though, the 7.8% from ADP, 6.2% over total compensation, 4.9% just for hourly workers, they're still not keeping up with inflation, which means you're going to be having to increase the pay if you want to be retaining employees or finding new employees this year to make sure that you are staying comparable. That's going to be adding into your cost structure this year. All those things are going to be impacting you as well. Listen, the news isn't all that bad, but before we even get to that, let me just also tell you this. Here, we are looking at the federal government, and the federal government itself is, right now bringing down its level of money supply, but it's still extraordinarily high. Because at the beginning of COVID, the amount of money that was available for banks to lend out into the money supply was only about $16 trillion only, right? Since then, and although it's gone down, it is now still at a level about $5.7 trillion more than it was about 2 years ago, which is unbelievable amounts of money that's out there. Some of it was good reason. A lot of liquidity provided to banks in what was a financial crisis not seen in our lifetimes. That's good, because without liquidity, banks go bust. We saw that in the Depression. But then there was stimulus payments that were made for unemployment and paycheck protection loans, also needed and good. But since then, there's been a few $1 trillion in other stimulus bills that in a dubious value to them. But that's all added to the amount of money that is available in supply. We're in a slowing economy. There is less of a demand for this money. When there is less of a demand chasing too much of a supply of something, what does it do to the value of the supply of that something? It decreases it, which is why we're seeing inflation. There are so many dollars out here, a supply of dollars available, that's not having the demand for it right now. And because of that, it lessens the value of the supply itself. What the Fed is trying to do is to bring down that supply by increasing interest rates. That will have an impact eventually, but it's going to take some time to do. So fiscal management is impacting all of this, as well as what we're seeing with overall supply chain issues. All of that is having an impact on inflation. So we talked before that parts of the economy are in a slowdown. But, guys, it's not another great recession, okay? It just depends on who you ask. And also, prices across the wall and ceiling industry have risen significantly more than what the government is saying in the producer price index. I just showed that to you. Inflation is going to continue to be a challenge for the next 6 to 12 months. You got to prepare for it. Now, I have told you all of this. This should be no surprise to you. You cut the checks, you sign checks, you see the invoices, you know what's going on in your business. You know that prices have been going up. You see that the economy is slowing down. Many of my clients and readers had a pretty decent year in 2022, but now that they're looking ahead over backlogs and orders right now, they're starting to see less and getting concerned. So you know this. None of this is news to you. Your question is, okay, so what do we do about it? Right? If I know inflation is going to be around for the next year, if I know we're in a slowdown economy, which is going to last for the next 6 to 12 months, how do I navigate my way around it? What are other smart business people doing to navigate their way around this current economic situation? That's what I'm about to share with you right now. I've been talking to many around the country. I have been writing about this for the past year. I've been talking to my clients. Here is what the smartest executives and business owners are doing to manage their businesses in a downturn year with high inflation. Are you ready? Number one, many of them, of course, are revisiting their pricing. We get that, right? But they're doing something different, because we have something different that our parents and grandparents did not have back in the late 70s and early 80s, the last time there was a big slowdown like this with inflation and high interest rates. And let me tell you what that is. We have data. They didn't have that. We do. So how are my smartest clients taking advantage of the data that they have? They are leveraging that data to target their price increases. They're not just having an across-the-board price increase on all products, because that's lazy. When they've got the data available, they can target their price increases, and they are targeting their price increases to specific customers, specific industry, specific regions, specific areas of the country as well, depending on what they want their margins to be. I have some people I talk to that they are not increasing prices, even in this inflationary year, to some of their best customers, because they're like, you know what? Our margins have been fine. I can eat a point or two. These guys are great. They've been selling to, we've been selling to them for years. I'm not going to increase prices. But they'll also turn around and increase prices on some of the customers that are their biggest pain in the neck. I hate that guy. I hate his kids. I hate his house. I'm going to increase prices on this guy 15%. They are using the data itself to make their strategic decisions. It's all about margin, guys. So you need to get margin numbers by customer and by product line, so you can really focus in and decide on where you want to increase prices to maintain your margins and where you can pass by on those price increases. Listen, this is not advice. I am just reporting to you what I'm seeing my clients do this year. You want to consider that as well. So that's number one. Number two, another thing that you have that your parents and your grandparents didn't have 30 or 40 years ago, and it's this. You've got Outlook, you've got Gmail, you've got Salesforce, you've got Zoho, you've got Dynamics, you've got systems for communication. And your parents and grandparents didn't have this kind of stuff. So what are my smartest clients doing about this? They are zeroing in and doubling down on their communication systems. They don't just blast out emails to everybody. They have targeted, segmented lists of customers that they are reaching out to let them know lead times, back orders, job status, and in advance when price increases are going to come. Because those customers understand that we're in an inflationary environment. It's not going to surprise them that they're getting a price increase. They just want to know when. So if you know you're going to see price increases on the horizon, it's October now, maybe it's going to be in January or something. Tell them now. Communicate with just those people so that they can make their plans and navigate their businesses around all. That's what they want to know. That's what you want to know when your flight is delayed. Like, where is the incoming flight and when will this eventually take off? People need those communications. And by the way, it's email, it's old school phone calling, and it's a lot of text messaging as well, because there are some great text messaging technologies out there where you can communicate to those customers who opt in and want to get updates that way. Leverage your communication systems, guys, all right? Make sure your customers are up to date. Stay close with them. These are your CRM systems, your customer relationship management systems. Again, I'm seeing my smartest clients do just that. Number three, my smartest clients are forecasting. Remember I showed you that slide of like, I don't know if you laughed or not, but it was, the pilots, guys, are always looking ahead and they're looking behind smiling, and meanwhile there's like a plane that's coming, right? Did you find that funny? Whatever. They're looking ahead. And my smartest clients are always looking ahead. If I were to ask you right now, what is your cash balance projected to be the end of this year? We're here in October. Can you tell me? Can you tell me what it's going to be like January 31st? Can you give me like 90 days from now? What's your cash going to be? I bet you can't. Don't feel bad, because most of my clients can't. It's not, right? It's not something like you think about right away. You need to change that. And that's what I've learned from my smartest clients, because my smartest clients are always looking ahead. They forecast. They avoid surprises. They can't eliminate them, but they minimize them. So they're doing forecasts to make sure they don't get surprised. And doing a forecast is pretty easy stuff. It's honestly, I'm just asking 90 days. I don't need you to forecast all of 2023. For God's sake, there's no way you can do that. But 90 days, do you not know what your overhead's going to be over the next 3 months? Of course you do. You know what salaries are, what your payroll's going to be. You know what your rent is. You know what any lease payments that you have or debt payments that you have. All of that, that's your overhead. You know what that's going to be, your utilities, bills, right? You can project that for the next 90 days. Do you know what your margins are? Okay, yeah, different margins for different product lines. Take an average, okay? This is not an exact science. Everything you sell, you get about a 20% margin or a 30% margin, okay? Pick a number that you think is a reasonable margin that you can use to represent all of your products. The last thing you don't know is sales. But do you really not know what your sales are going to be over the next 90 days? Do you not have a pipeline report? Do you not know what your back orders are or what your open quotes are and what's going to close? Can you not talk to your salespeople that are sitting right there and ask them? Have you not been in business for more than a few years? You can go back to October of 2018 and 2019 to see what sales were then. Yeah, you can. You can come up with a fairly reasonable estimate of what you think your sales will be for the next 90 days. So think about this. You've got your estimated sales, an estimated margin, and your overhead. Now just say, okay, in the next 90 days, are there any big payments or things happening that are out of the ordinary? An estimated tax payment, a balloon payment to your loan provider, your financer. Put that in as well. You'll be able to roll yourself forward. Do this every month. You will always know where your cash will be in the next 90 days. It will change your life because the best way to manage a business is to minimize surprises. And my smartest clients, they minimize surprises by forecasting. And if there is not a time to learn that lesson, there's no better time than right now. So forecasting is big. Next, shrinkflation. Do you know what shrinkflation is? Shrinkflation is like when you sell a little less of something, but for the same price, okay? That's called shrinkflation. Now that might seem unethical or immoral, but let me tell you something. It's kind of happening all over the place. I mean, if you go to like Walmart, their great value paper towels used to be 168 sheets in a roll. It's now only 120 sheets. Same price. If you buy a bag of Doritos, used to be 9.75 ounces. Now it's 9.25 ounces. Same price, a little bit less. Toilet paper, the super mega rolls that were made by Charmin, they are half the size that they used to be at the same price. This is a serious situation for some people. In addition, if you buy hefty bags, used to be 90 bags, now it's 80 bags. Same price. If you go to Domino's, you're not going to get fewer chicken wings in a carry-out bag than you used to, but for the same price. And who is buying chicken wings at Domino's? It's a pizza place. Besides Domino's, go to Burger King. For the same price, you're no longer going to get 10 nuggets, you're going to get 8 nuggets. You get my point? Everybody, every major brand, everybody who's smart are practicing some form of shrinkflation. Jonah Hill is practicing shrinkflation right now. That's how popular shrinkflation has become. Can you do that? When you look at your business, can you be selling a little less of something, providing a little bit less services, but for the same price? I'm telling you, it's all about margin. And if you're able to do that and get away with that, that is something that so many business owners are doing right now to navigate their way through these inflationary times and the slowdown in the economy. All right, let me give you another one, and that's buy. I am seeing my smartest clients buy. Don't buy crypto, for God's sake. Don't buy a Bed Bath & Beyond shares or GameStop or whatever. You don't know anything about that. Don't buy stuff that you know nothing about, okay? You know your inventory, though. You know your equipment. You know property, right? At least as it pertains to your business. That's what you buy. You buy what you know. And if I'm telling you right now, you've seen the data, you see where the trends are going. If you know the prices are going to continue to increase over the next year, why wouldn't you buy something at a lower price now if you know you'll be able to sell it for a higher price later? Like, why wouldn't you do that? Particularly when it's materials in your own industry that you know better than anything else. My smartest clients are buying. They're buying inventory, they're buying equipment, and they're buying property as well. That's a great place to bet on, particularly in a slowdown and inflationary times. Now, if you need financing, let me give you some advice. Go to the Small Business Administration, the SBA. The SBA, I'm not talking about the COVID stuff. PPP is over. The Economic Injury Disaster Loans, it's over. It's none of that stuff I'm talking about. I'm talking about standard loans that the SBA has been offering for decades now. The SBA offers something called a 7A loan. They also offer something called a 504 microloan. The 7A loan that they offer it goes through their network of SBA bankers. These bankers are required. They have a quota of loans they need to be given out if they want to remain an SBA banker. It all gets guaranteed by the government, and they all make good money on it. They're looking for you. They're looking for established businesses with employees, with assets that are a safer bet than the mom and pop or the coffee shop or some angel entrepreneur somewhere. They are looking for people to lend to that have got a core history, and you do. And when you borrow money from the SBA, you can do so at or below market rates. You can go up to $5 million under a 7A loan. Use it to buy inventory or property and equipment or just for working capital. So if you're looking for financing this year, go to the SBA banks for your financing. Also, see what I have here? SSBCI. That stands for State Small Business Credit Initiative. $10 billion is now going to the states across the country this year from the Treasury Department. $10 billion. It was authorized during COVID to provide help for small businesses. And of course, it's just getting out now when COVID is pretty much behind us. But that's okay. It's going to states depending on their GDP and their population. Google State Small Business Credit Initiative in your state. You will see in your state where the money is going to. You can get this money for your small business in the form of a grant or a loan or an equity investment. Cheap, 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 free in some cases as well. And again, although some of that money is earmarked towards minority businesses, most of it is earmarked towards established businesses like yours, where you can get really, really favorable financing if you want to go down that route to get money. It's not from the state, but the state is then dispersing it to organizations, community banks and lenders and other nonprofits to help out small businesses in the area. Look up the State Small Business Credit Initiative in your state. Now, again, just want to remind you, if you need any reminder, just look, I'm a CPA, okay? So I can't let this conversation get by with at least sharing with you some tax advice, right? I mean, for God's sake, it's only 20 to 30% of your income, no big deal, right? Well, here's some things I want you to consider this year. Number one, if you buy equipment between now and the end of the year, a forklift, a car, furniture and fixtures, your racking for your business, right? You could deduct up to $1.1 million immediately. Just write it off that year. Some of your own products might be eligible for your customers when they buy from you as well. It's called the Section 179 deduction. Take advantage of it. And remember, you can buy that equipment, finance it, defer payments to 2023. As long as you put it into service this year, you get the full deductions. Take advantage of that. Number two, I have a lot of readers and clients that are starting to do sale leaseback deals because property values, although they've fallen a bit, are still sky high. So they're taking the time to then taking advantage to sell their business property and then go into long-term leases. That way they can cash out on the property and then get a big tax deduction going forward because those lease payments are fully tax deductible as opposed to a mortgage payment where only interest is tax deductible. So sale leasebacks are also becoming much, much more popular. Wash sale of stock. If you have stocks where you have a bunch of unrealized losses, you lost money on those stocks. We all do. It's been a lousy year in the stock market. Well, if you sell those stocks, whatever loss that you have, you can offset it against any gains that you have. And $3,000 of that loss can go against your income as well, just your regular ordinary income. Think about a wash sale of stock. And what that means is this. Say you've got a stock, you love the stock, they've just been down. They're having a lousy year, and you're like, I don't want to get rid of this stock. I think there's great potential in the future. Okay, sell the stock, realize the loss, use it to offset any gains or take that $3,000 offset against your income. Wait 30 days, buy the stock back. As long as you do that, you can take that full deduction and then you can re-own the stock again. And let's face it, you really think the stock's going to increase that much in the next 30 days? I mean, the market is in the can right now. So I think you'll be okay if you take advantage of that now, and then you get some big tax advantages for doing just that. Finally, the IRS got $80 billion in funding this year from the Inflation Reduction Act. That's going to be 80,000 new IRS agents and upgrades to their systems as well. More audits for everybody. Don't believe the government when they say it's only going to affect people making more than a certain. It's going to affect everybody, particularly your business. If your business is making more than $400,000 a year, your chance of an audit has gone up significantly. So just make sure you keep your books in order and prepare for that because that's going to impact us over the next couple of years. Finally, when I talk to my clients, my friends, my readers, business owners around the country, what are they doing to navigate this year? They're all investing in technology. So let me give you these 4 technologies you want to be evaluating this year. 1, accounts payable automation. Bill.com and AvidXchange are 2 examples. They cut out overhead by getting rid of accounting people. I'm sorry, it's just that's the reality of 2022. You tell your suppliers and vendors, email me your invoice. Bill.com will receive it, for example, scan it, put it right into your accounting. So I don't care if you're using QuickBooks, Sage, Xero, Epicor, whatever, goes right in. Then you can approve it if you want to or not, and then it sets up for automatic payment with your bank as well. In other words, you can have an entire vendor system that you've got recurring payables and things that need minimal supervision, and then it goes in, accurate, imported, put in, out, and paid, scheduled for payment without any human involvement. Cuts overhead. That's 1. Number 2, if you've got more than, say, I don't know, 100 invoices a month, 150 invoices a month, consider investing in accounts receivable automation. BillTrust is the leader there. That platform will not only do automatic billing, but it ties into your bank. So when people pay, it'll literally match the payment with any open invoices, spew out an exception report if anything is wrong, but the rest goes right into your accounting system, eliminates accounts receivable people. If you are complaining because you're not getting up-to-date information, or say you want to do that cash forecast or want to be looking at it all the time, you're like, oh, I make a request and my accountant doesn't send me my information for 2 weeks. Baloney. Invest in a mobile reporting or analytics application. I'm seeing a ton of clients do this. Microsoft BI and Domo are 2 good examples. You can Google their competitors, by the way. You can get an expert from LinkedIn who understands these applications. They can build a few reports for you. It'll cost you a few grand. And then on your phone, you want to know what your cash flow report is? Boom, you got it. You want to know what open orders are right now? Whew, you've got it. You want to know what sales came in that day or cash receipts that day? You're not calling your accountant or controller about this. You pull it right up on your phone and you see it. Focus and leverage some of these mobile analytics applications. They will really help you run your business much, much better. Very important in these times. Finally, there's security training. Ransomware attacks have gone up 300% in just the past 2 years because of what reason? We're all working from home and we're all dopes, right? We're sharing our computers with our 7th graders. Our routers still have the same passwords on it that came with Linksys. I could go on Linksys's website and see that your password on your, because it's all the same, right? We're terrible. We're being begged by Microsoft to upgrade our operating systems and we ignore them. And because of that, hackers are doing what they do, and they're launching ransomware and malware attacks. Invest in a product like KnowBe4, because the #1 reason for a ransomware attack, which can bring down your business for days or weeks or permanently, is because we're dopes, because people don't get trained, because we don't recognize a phishing email or malicious website or some type of email that we're opening up attachments to it. KnowBe4 will try and dupe you and your employees. It will send you out email messages and other solicitations to try and persuade you to click on something or download something. And if you do it, you're caught. And what KnowBe4 is, will report that so you can learn from the experience without having been really affected. It's been a very, very popular application among my clients for the past year or 2. So guys, this is what people are doing to navigate their way through this recessionary year. Just want you to know, talk to you again in another year or 2. Maybe there's some other things, but this is what people are doing. So we're in a slowdown, but it's not a great recession. Inflation's going to continue. All these things, right? Revisiting pricing, improving communications, investing in tech, buying inventory and property. These are all among the strategies people are doing in 2022 and also in 2023. Now, a couple things I want you to be aware of from the Labor Department. This guy that you're looking at right here, this is Marty Walsh. He's the Secretary of Labor. There are a lot of changes coming from the Labor Department that I want you to be aware of because they're going to impact your overhead cost basis and your ability to retain and attract employees. So stay ahead of these things. #1, minimum wages around the country are rising. I'm expecting there to be another minimum wage attempt by Congress after the midterm elections. There's a lot of bipartisan support to send it to as high as $12 an hour nationally. If you're paying somebody right now $16 an hour, Yeah, they're making more than twice the national minimum wage. When it goes up to 12 bucks an hour, what are those people going to say? They're going to want an increase too. So keep an eye on minimum wages rising. Number two, just wrote about this for the Philly Inquirer this week. You can find it online. Overtime wages are going to be going up soon. Right now, if you have any employees that are like salaried and not supervising anybody, and you're paying them more than like $35,000 a year, you're not going to have to pay them any overtime, okay? That number is going to go up anywhere from $50,000 to $80,000 a year, which means when this rule comes out sometime in the next year, that same employee that you didn't have to pay overtime, if they're making under 50 or as high as 80,000 a year, depending on the rule, you're going to owe them overtime for their time, any hour over 40 hours. Remember, the Department of Labor is going to come and find you. That employee will report you to the Department of Labor if that certainly happens. More unionization activity is now being allowed by the Department of Labor, the National Labor Relations Board. The EEOC, the Equal Employment Opportunity Commission, have got a 16% increase in their budget and are increasing their activity around the country, focusing in on discrimination and harassment. Your employees, any employee, can now go directly to the EEOC, to their website, and fill out a new form to report a discrimination or harassment case directly to the EEOC without you even knowing about it. So you've got to make sure you've got procedures and policies in place to make sure either that it either doesn't happen or it's dealt with if an incident does occur. Non-compete rules are going away. It's already happening in a lot of local jurisdictions. You know, you have your employment contracts. There's a non-compete clause which says if you come and work for us and then you quit, you're not allowed to work for any company anywhere in the universe for the next 50 years, you know, that kind of thing. Well, these non-compete clauses, you know, have been found by the Biden administration and a lot of other localities to, you know, hinder employees available to find other jobs. They're going to be going away. The Department of Labor is looking at potentially taking action to reduce the validity of these non-compete laws. Pay transparency rules are being looked at by the Department of Labor, which means that, because it's also in certain localities, you can't offer a job without at least stating what the range of salary or compensation is going to be, because it's discriminatory otherwise. Women have been known to earn less than men. So if you're interviewing a female job candidate and you ask her what you earned at a previous job, or you don't disclose what this pays, so she's only going off of what she earned at a previous job, she might be starting off behind the 8 ball. That's discriminatory. So new jobs that you list nationally, as the Department of Labor is looking at this, would be required to include what a range of pay would be, compensation. So you want to start doing that now or thinking about that. And finally, there's worker classification rules as well. This is a big one that you need to be aware of, particularly for this industry. Worker classification rules are now under scrutiny. There has been a new proposed rule that was issued by the Department of Labor just the past 2 weeks ago that is going to change how you classify your 1099 workers. What that means is if you have any 1099 worker that is generating revenue for your business, which means a worker that you are billing out to your customer. Maybe it's a driver. Maybe it's a specialty contractor. Maybe it's somebody that's putting up stuff that you're doing with it. You're just paying them as a 1099. Well, guess what? If you are doing that and you're including their cost as part of your revenue, you're billing them out to your customers, that worker may need to be classified as an employee. And if they're an employee, they get employee benefits. You have to pay payroll taxes. They've got the ability to unionize. So they've got all the rights of an employee. So you need to look at any of your 1099 workers, because this rule is going to happen before the end of the year. It's been proposed right now by the Department of Labor, and it will go into effect sometime soon. That will have a big impact on how we classify workers going forward. Finally, in the last 10 minutes that I have, we're talking about the issues that are affecting our business. Obviously, the biggest issue, one of the biggest issues besides inflation, is labor. Finding people and keeping people and all that kind of stuff. 10 million unfilled jobs. Downside with the recession is that there might be some people coming available in the labor market that we might have the opportunity to snap them up. Okay, well, if that's the case, we still have to be providing competitive benefits. Now, I'm not a labor attorney. I'm not a specialist in labor. I'm just a reporter. So all I can do is I can share with you what businesses around the country, what hot benefits there are that people are offering to their employees, okay? So obviously, number one is Healthcare, we realize that. It's the number one benefit that's asked for. 4 things on healthcare I want you to know about. Number 1, offer health savings accounts, HSAs. They're like a 401k for your healthcare plan, very inexpensive. They attach to a high deductible plan. People can put money away pre-tax, take it out for unreimbursed medical expenses. It carries forward with them. It can leave with them if they leave your company. Get a health savings account for your employees. Number 2, HRAs. Not a bad thing to consider if you've got less than, say, 50 employees. You might decide to not offer health insurance at all, not even have a group plan. Instead, what you do is you say, listen, instead of us paying for your health insurance, we're going to take that same money and put it into an HRA for you. So it's tax deductible. It's not taxed. You get a deduction for it. Employee doesn't get taxed, but then they can take that money and get their own health insurance. They can go to the healthcare exchange. They can talk to a list of providers that you might want to give, brokers that you can submit to them. But it takes you out of the health insurance business and reduces your admin and your fiduciary responsibilities. So HRAs, health reimbursement accounts, have been another popular thing. Level funded plans have been hugely popular. If you have a young workforce with a good health history, you're probably paying too much for health insurance because you're probably paying for group insurance for your employees. Stop doing that and get a level funded plan, because that way you say to your employees, listen, for the first, $1,000 in expenses, come to me, I'll write you a check and reimburse you for that cost. Anything over that, the group insurance plan kicks in. If you do that, first of all, you're not going to be paying health costs for a lot of your employees if they never use their health care anywhere, if they're younger and don't have any health issues. Number 2, if it does kick in, a group insurance plan will cover any catastrophic liabilities. And because you're taking the risk at the lowest level, your group insurance rates will be even less, 5 to 10% less. So talk to your benefits administrator about a level funded plan. And finally, if you are going to be given pay raises this year, as I talked about earlier, the rates of compensation going up, right? If you're going to get pay raises, here's my advice to you. Don't give a pay raise. Pay more for your employees' health insurance. Contribute more towards that. Why? If you give your employee a pay raise, they get taxed on it. So they're not even getting the full raise. You have to pay employer taxes on it as well. So that kind of sucks for everybody. However, if you pay more of their health insurance down, they don't get taxed on that at all. And you get the full deduction. And in the end, their paycheck will still be higher because you're paying more for their health insurance contribution. So pay for their health insurance instead of giving them a raise. It will benefit both you and your employees in a number of ways. Next, retirement. The only comment I have on retirement is ask your retirement administrator, your 401k administrator, about pooled employer plans. They are now allowed by the 2019 Secure Act. With a pooled employer plan, it makes really very little difference to your existing 401k. You're pooling the assets with 1,000 other companies, which means you're sharing costs and you don't have any liability. It's a huge help for businesses and will reduce the cost of administering your 401k plans. Ask about pooled employer plans. Number 3, you gotta have flexibility with your workforce. Everybody's asking for that. You need to be offering work from home options, maybe a 4-day work week option. Don't laugh. You can have 4 10-hour shifts. So for your people that are working, that's a 4-day work week. You think that might sound crazy? It's not crazy at all. People love it, and it is a selling point if you're trying to attract employees, particularly younger workers as well. See if you can make a 4-day work week schedule work. And of course, revisit your PTO. A lot of companies offering unlimited PTO plans nowadays. And the reason why is because it's highly requested and you can control it. Yeah, it's unlimited PTO, but you can't take PTO unless a supervisor approves it. So don't think it's so unlimited. It can be very much of a great benefit to provide and good for mental health, but you can still keep it controlled as well. Great selling point to attract employees to your business. Hiring bonuses. You're looking for people. Here's where you want to look for people. You want to go to groups that get jobs for veterans out of the military. You want to go to the state, and you want to go to groups that provide resources for convicts coming out of prison, for prison reform, people that have served their time and now looking to get back in the workforce. You want to go to the state job boards to get people off of welfare as well. Or you want to find somebody that's been unemployed for more than 6 months. If you hire any one of those 4 people, the government will give you up to a $9,600 tax credit against your income taxes or your payroll taxes. So consider doing that. It is a great way to hire new workers and then have the government give you a tax credit, share the tax credit with the workers so that, you want to hire somebody, you're going to get maybe a $5,000 tax credit, give them a $3,000 hiring bonus, you're still $2,000 ahead. Provide mental health benefits. It is a highly requested benefit, particularly from younger millennials and Gen Zers. Look at platforms like Fringe and BetterUp. BetterUp is a few $1,000s a year. Your employees can get confidential, private counseling from psychiatrists and psychologists on this platform to help them with their mental health as well. People are going to ask you, I went through a lot of anxiety or depression or issues during COVID, trying to get back to the workforce. What type of mental health benefits do you provide? This is not a stigma anymore. You've got to have an answer, and these are great, great platforms to consider. Provide help with student debt. I know the President's Loan Forgiveness Program has been out there, which is fine, but still lots of more student debt that's out there. Thanks to one of the COVID bills, you can get a $5,200 deduction for providing help with student debt assistance, so consider doing that. You can administer it all through a platform like tuition.io. A big request and continuing to get bigger is dependent care. Our parents, they just keep living and we have to care for them. And our kids are young, and you've got, young people in their 20s and their 30s who are trying to raise families or pulled in a million different directions. They get child care tax credits, dependent care credits. You can provide dependent care assistance up to $5,000 a year. You get a deduction and they don't get taxed on it. Could be the difference to hiring that great employee. Offer same-day pay. Don't laugh. When I say same-day pay, what I mean is you pay 50% of the compensation that day, the other 50% at the end of the payroll period. Very, very highly requested. If your cash flow can do it, it could be the difference between hiring that worker or losing them to somebody down the street. You say, hey, come and work for us. We have same-day pay. You work for us for 90 days. We'll start paying you on the exact same day, 50% with the remainder at the end of the period. And finally, consider employee ownership. ESOP plans, employee ownership stock plans, have exploded in popularity for a couple big reasons. Number one, we're getting older. The average age of the U.S. business owner is 55. Many of us have been thinking about succession planning, and a lot of us are starting to realize we might not be able to get the value for the business or even a buyer for our business that we were hoping to get. Meanwhile, we've got built-in buyers in our own employees. Setting up an ESOP comes with huge tax benefits. I can't have the time to go into them right now, but huge tax benefits. And it's an amazing benefit to provide to your employees because people today, they want to say in the companies that they work for. What better way to attract an employee to a company than to say, come and work for us, and if everything's good after a year, you can be a shareholder in our company. It's a huge selling point, something to consider. If I persuaded you to even think about an ESOP for your company, go to employeeownershipequals.org. It's a nonprofit website that you can get some counseling for free on what would work best for you and how it would work best for you as well. Okay, so let's wrap things up. Parts of the economy are in a slowdown. No, we're not in a whole recession, but parts of us are in a recession, and it's certainly not another great recession. Prices across the ceiling and wall industry have risen significantly more than the 8.5% the government is reporting under PPI, and that's going to continue for at least another 6 to 12 months, at least. To navigate your way around this slowdown and inflationary times, revisit pricing, improve communication, invest in tech, all these different things will help you do. That's what my smartest clients are doing. Labor regulation on the rise. Be aware of potential new overtime rules, pay transparency rules, worker classification rules. These are among some of the things that you've got to stay ahead of to make sure that you're competitive and not getting into any trouble. Health insurance, retirement, hiring bonuses, flexible scheduling, mental health, student loan assistance, same-day pay, ESOPs. These are among the hot benefits that people are using this year to attract and retain good talent. Those are the issues we're facing. That's what people are doing right now. So guys, I hope this information was helpful. So a few things. Number one, if you would like a copy of this presentation via PDF, email me, gene@marksgroup.net. Feel free to come. And if you have any specific questions that I have not covered in this, feel free to email me whatever questions that you've got, and I'll be happy to respond to you directly and specifically about your business. You can follow me on Twitter at Gene Marks, and I write in a bunch of different places, but I post it all onto my Medium account at genemarks.medium.com. If you want to follow me there, you'll stay up to date on all the things I've just talked about and more. You'll know what I'm talking about in presentations when you see about the stuff